It's me again, John Persinos, Editorial Director of Investing Daily, with a video presentation for Monday, February 22nd. Will we see significantly higher inflation several years down the road? Sure, maybe. But as economist John Maynard Keynes famously said, in the long run, we are all dead. What did this giant of the economics field mean by his oft-quoted remark? Simply this: immediate financial needs often can't wait for historical inevitability. During pandemic-afflicted 2021, worries about inflation are premature. Let's see what's driving markets and how you should position your portfolio now. Stocks finished last week mixed, with the Dow Jones Industrial Average carving out a slight gain. Overall, equities continue to hover at record highs. House Democrats last Friday unveiled President Biden's full $1.9 trillion fiscal stimulus bill, with enactment likely to occur sometime in March. This outcome, much desired by Wall Street, already is priced into stocks. The following graphic shows market action last week and year to date. Economic data have been mixed. Retail sales and home prices are strong, but unemployment levels are stubbornly elevated. Often lost in the parsing of the numbers is the fact that the labor force participation rate is lower than it was before the COVID-19 outbreak, as many frustrated Americans quit looking for jobs. Paradoxically, weak employment numbers are fueling the rise in stocks because the pain in the workforce motivates lawmakers to pass a relief package. The economy is grappling with headwinds from lockdowns and quarantines, but the table is set for growth amid vaccination rollouts. Part of Biden's proposed package includes extended jobless benefits that are slated to expire in mid-March. Without this extension, many Americans would find themselves destitute. The U.S. Labor Department reported last Thursday that first-time filings for jobless claims totaled 861,000 last week, above the consensus estimate of 773,000. The total for the week ended February 13 represented a modest increase from the 848,000 a week earlier. Take a look at my second chart. My outlook, it remains bullish. The enactment of fiscal stimulus would sustain the current rally, although it wouldn't necessarily result in a pronounced surge in equities. Markets are forward-looking, and investors have been anticipating this result. Meanwhile, many of my readers have been sending me emails expressing concern that fiscal and monetary stimulus will trigger inflation. In their messages to me, individuals are reporting anecdotal evidence of rising retail prices, whereas in their messages to me, small businessmen are lamenting recent spikes in raw materials prices. I'm not worried about inflation. My biggest concern is that fiscal stimulus won't be big enough. Let's not forget, we suffered the worst economic downturn last year since the Great Depression. The voices expressing alarm about inflation, well, they're fighting the old wars of the 1970s. Inflation projections for 2021 are modest. The Fed projects that core inflation, which excludes the cost of food and energy, will run at about 2.2% in 2021, up from 1.6% at the end of 2020. Look, when 10 million Americans remain out of work, a modest amount of inflation too, as Keynes would put it, prime the pump, is desirous. The inflation hawks you've been hearing on cable news lately are driven by their preconceived ideological antipathy to government action of any type. We may see a spike in prices later this year, but it won't represent a multi-month secular rise. In addition to slack in the economy, other factors should keep inflation from returning to the hyper levels we witnessed during the stagflation 1970s. Globalization is more pronounced than it was back then, which keeps a lid on wage growth. And the graying of society also dampens inflation. The inflation alarmists point out that interest rates are rising, and indeed they are. Take a look at my third chart. The argument goes that higher inflation would cause the Federal Reserve to tap on the brakes by raising rates, thereby killing the rally. I'm not buying that argument. For starters, the Fed is purposely trying to foster a modest amount of inflation. That's the policy right now. If inflation flares up, the Fed will remain patient and not overreact, knowing that price pressures will be temporary. Rates are rising, yes, but for reasons that are beneficial. Inflation expectations are higher, but this reflects the comparison to this period in 2020 when prices plunged as demand imploded due to pandemic lockdowns. The recent rise in interest rates that has been driven by higher expected inflation is actually a good thing because it points to an economy that's rebounding. What's more, interest rates continue to scrape historic lows. Higher rates don't equate to high rates. The signs point to a healthy economic rebound in 2021, providing enough juice to sustain the stock market rally. As the economic recovery strengthens, economically sensitive growth stocks should outpace the broader market this year and beyond. Okay, that's it for today. Do you want to weigh in on the great inflation debate? Send your questions and comments to Mailbag at Investing Daily. I'd love to hear your views. Thanks for watching and see you next week.